$10,000 invested in the S&P 500 in 2005, held through every recession, every crash, every news cycle that told you to panic. By the end of 2024, that turned into $71,750. But here's where it gets uncomfortable. If you missed just the 10 best days of the market during those 20 years, just 10 days out of 5,000, that same 10,000 only grew to 32,000. You'd be down by more than $38,000. Not because the market was wrong, because you were out of it. That's JP Morgan's 2025 Guide to Retirement, and it's the single most important fact a beginner investor can understand. In the next 10 minutes, I'm going to show you exactly how to invest in scary markets without trying to time them or making the mistakes that cost beginners most. Here's the part nobody tells beginners. Every single time there has been a market crash, 1987, 2000, 2008, 2020, 2022, the market has not only recovered, it has gone on to hit new all-time highs. Every time, the investors who built real wealth weren't the ones who predicted the crash. They were the ones who kept buying through it. So if you're new to investing, the answer isn't to wait until things feel safe. The answer is to use a system that takes the timing question off the table entirely. The first rule of investing in scary markets is match your money to its timeline. Anything you need in less than 3 years does not belong in the stock market. The market can drop 30% overnight, and if your goal date arrives during that drop, your plans break. Short-term money lives in high-yield savings accounts, GICs or treasury bills, places where the value cannot suddenly fall. But money you genuinely don't need for 10 or more years, retirement, long-term wealth, that money belongs in the market. Time becomes your weapon. Before you invest a single dollar, put it inside the right account, because the right account can save you thousands in tax or get you free money. For Canadians, the big ones are the TFSA and the RRSP. The TFSA is flexible and tax-free forever. The RRSP is your retirement workhorse. The RESP is for a child's education. And the federal government adds a 20% grant on your first $2,500 per year. That's free money. For Americans, the Roth IRA grows tax-free forever. The 401k is your workplace plan, and you must capture the full employer match. If your employer offers a match, you have to contribute enough to capture it. We're talking thousands of dollars of free money per year. Get the account right first. The investment goes inside the account. Now, the question every beginner asks, what do I actually buy? For most new investors, the answer is a broad-based, low-cost index ETF. You're not betting on one company, you're owning a slice of the entire market. Here are starting points to research. In the US, VTI, VOO, and VT. In Canada, XEQT and VQT are all-in-one global portfolios. Index ETFs charge less than 0.25%. Mutual funds average 2%. That difference can be hundreds of thousands of dollars over 30 years. This is the math that should make every 20-something stop scrolling. Investor A starts at age 22. She invests $300 a month for 10 years. Then she stops. She never contributes another dollar. She just lets it sit. Total contributed, $36,000. Investor B starts at 32, exactly when Investor A stopped. He invests $300 a month for 30 straight years. Total contributed, $108,000. At 7% return by age 62, Investor A has $520,000. Investor B has $365,000. A wins by a mile. She contributed 3 times less money. She ends up with $150,000 more. That gap is the cost of waiting 10 years to start. Here's a piece of math you can use forever. It's called the Rule of 72. Divide 72 by your return, and you get the years for your money to double. At 7%, your money doubles roughly every 10 years. $1,000 today becomes $16,000 in 40 years, from $1,000, one time. And if you're thinking you missed the window, you didn't. The best time to plant a tree was 20 years ago. The second best time is today. How do you invest when markets are scary? Dollar cost averaging. You invest the same amount, on the same day, every month. No matter what. When the market drops, your money buys more shares. When it's high, it buys fewer. You naturally buy more when prices are low, without predicting anything. People who dollar cost averaged through the 2008 crash came out ahead of those who waited. The crash itself became the opportunity. The key is to keep buying when it feels worst. Set up an automatic transfer and a recurring purchase. Your emotions are the enemy of your returns. Mistake 1. Putting soon-needed money in the market. Mistake 2. Panic selling. You turn a temporary paper loss into a permanent real loss. Mistake 3. Chasing hot stocks. Mistake 4. Putting everything into one company. Diversification is the only free lunch in investing. Mistake 5. Waiting forever to start. Every year you wait costs you exponentially. Starting imperfectly is better than waiting for the perfect moment. Here is your 30-day plan. Week 1. Write goals and timelines. Week 2. Build an emergency fund. That's your foundation for peace of mind. Week 3. Open the right account. Capture that 401k match or TFSA. Week 4. Pick a broad ETF and automate a contribution, even $50. There is no version of the future where investing feels comfortable. It will always feel scary at the moment when buying matters most. The investors who win aren't the ones who feel brave. They're the ones who built a system that doesn't require bravery. Start today, not when conditions feel right. What surprised you most? The 10 best days math, the compounding gap, or the DCA advantage? Drop your answer in the comments. Subscribe for more.